Hello, this is Mr. Smith with a presentation about economic solutions to some of the major macroeconomic problems we discussed in a previous lesson. This goes along with the second unit of Honors Economics, Public Sector Economies. So I want to look at these three problems: unemployment, inflation, and poverty, and talk about what the public sector, the government, does in order to respond to these. Let's start with unemployment first. Unemployment insurance is the most popular way that the government responds to unemployment, and many of you might be familiar with it from just seeing it on the news or referenced. And this, of course, is when people end up unemployed and they file for unemployment. We talked about some of the requirements for that the previous lesson, that they have to have looked for work within the last 30 days. And each state might have some different specifics included, but basically they have to go through the unemployment office's website or phone line and report activity, and they must have looked for a job within the last 4 weeks or 30 days. This is paid for, of course, by unemployment insurance taxes, which is taken out of people's paychecks. So the persons who are unemployed have paid into this program previously. And the percentage, of course, is going to be different from state to state, but typically around 10%. And the companies, of course, are going to report any fraudulent activity. So if someone pretends they're unemployed or if they've been fired for cause or anything like that, the company, of course, is going to report them so they're not able to get unemployment insurance. But otherwise, someone is laid off and they fill out their original paperwork or application with the unemployment office, and they're going to meet those logging requirements that I just mentioned. And they'll receive a pay for a certain percentage of their previous income. Obviously, it only goes up to a certain point. Someone who makes $500,000 a year is not going to get a huge amount of money. So it is capped off at a certain point and plateaued. But the point is, of course, is to have enough money to pay one's bills. You're not going to have a lot of disposable income during this period of time, and so it is lesser money than usual. However, of course, the idea is that eventually it will run out, possibly after 6 months. Sometimes this is extended by acts of the legislature, but the point is that you just have enough to get by in the meantime, and then eventually you'll find a job. Of course, there are many problems with this, as mentioned previously, that people will stay on it for too long. And the question is, when do we kick people off unemployment insurance? If they're making that job of $500,000 a year, for instance, should they take any old job that comes along, including a minimum wage job? I think most of us would say no, but at the same time, we would also argue it's not feasible to expect another $500,000 job a year to come rolling along. Same as someone was making $70,000 a year. We also wouldn't expect them to take a minimum wage job, especially in the first couple months. But at the same time, we wouldn't expect them to turn down a job for $65,000 or $67,000. We might even expect them to take a job for $55,000 in the first or second month. And as the time extends, of course, the person's urgency to take a job and our expectations of them taking a job probably increase. But it is going to be a disagreement about where exactly that time lapse happens and how low should they be willing to go. Should someone who makes $70,000 a year before, for instance, if the only jobs that are coming to them are $25,000 6 months out, should they continue to stay on unemployment insurance until they're able to get a job that can meet that requirement? Should someone be forced to sell their home during this period of time, or should they be allowed to stay on the benefits for a lengthier period? That, of course, is a matter of debate. There are also other things that go along with unemployment insurance, like job training. Some states offer job training through their unemployment insurance program to send people to school, trade school, or maybe even take some college classes. Usually there's a limit on the time length, maybe a certain number of weeks, or at the most, maybe 2 years. And during that time, they can receive benefits in the promise, of course, that they will get the training or education they need to get a different job and open themselves up to more of the labor market. The next one I want to talk about is inflation. Inflation, of course, is the rising prices measured by the Consumer Price Index, comparing, of course, the prices today to the prices of the past, a specific year, a base year, on the market basket of goods. And inflation is bad because it erodes our money. We have $1,000 saved in a checking account in the year 2020. It's not going to buy the same amount of stuff in the year 2030. And so it erodes our savings. If our retirement, our pension, or our Social Security payments are the same year after year after year, that also means we're not able to buy as much when we're on a fixed income. So inflation is bad, especially if it's higher, because then it makes it difficult to budget. So what can the government do about inflation when it gets above 3%? 3% and below is creeping inflation. It's the lowest, it's the best. Often wages or other things are higher than this, and so we're not eating away at our money as much. However, if it goes beyond 3%, especially if it gets above 6%, deep into chronic inflation, then the government needs to become concerned, because that's going to start wreaking havoc on the economy. And so there are basically two major areas that the government can concentrate on. One, in the United States, is specifically through the legislative branch, fiscal policy. And what they can do is, whenever inflation is higher, is to remove money from the economy, so that will perhaps cool or slow down or maybe even lower aggregate demand, which would be like having less people show up to an auction. So the prices for those items that are being auctioned off aren't going to go as high. What can they do? Well, they can increase taxes, direct taxes in particular. They can lower government spending, so the government is itself demanding less, and a reduction in the amount of government sector borrowers each year. So all of these things can decrease the overall activity and aggregate demand, so perhaps inflation isn't going to be as high. The danger, of course, is doing it too much, so you don't actually invoke a recession. And sometimes that might be necessary. Unemployment and inflation in the late 70s was really high, and Paul Volcker, the head of the Federal Reserve at the time, advocated, of course, that we might need to take on measures that would cause a recession in order to stop the double-digit inflation that was occurring at the time. But speaking of the Federal Reserve, the other area would be monetary policy. And monetary policy can control the growth of demand through an increase in interest rates. So the prime rate that the Federal Reserve puts on gets passed along to other banks, and then smaller banks and smaller banks. And so it can influence all variable interest rates to be lowered. And it can also raise interest rates to cause all the other ones, it can raise the prime rate to cause all other ones to increase. And if interest rates are increasing, then what happens is loans become less attractive. People are less likely to borrow money, and then less likely to spend money, because if they're not borrowing, they're not buying. They're not getting car loans, they're not getting home loans. And so all these things are not being purchased, and that decreases demand. And if people are making higher interest payments, they're taking more cash out of their wallets and bank accounts to make those payments. So less money to spend. Another thing that they can do, of course, is the buying and selling of bonds. The bonds, of course, for any type of institution, whether it's government or the central banking system or companies, corporations can sell bonds. It's basically what you're doing is you're issuing this bond, a piece of paper, so to speak. Of course, they can be digital, but a piece of paper, basically, that is saying, I am selling you some debt, and then you're going to get money back with a fee. You're going to get an interest payment on top of that. So if you have bonds, sometimes grandparents especially will buy people's savings bonds. If you have those, if you have that piece of paper, it means that you own part of the government debt, and they're going to pay it back to you with interest. And so the Federal Reserve also does this. They have bonds that they can buy and sell. And so if they were interested in controlling inflation and bringing it down, cooling the economy, they're going to sell bonds. So they're going to go to the smaller banks, maybe regional banks or other national banks, and they're going to say, hey, why don't you buy these bonds? You're going to buy part of our debt. We're going to take the money from you when you get these bonds. We'll pay it back with interest, and that's the motivation for them to do that. But they're removing money from the economy. So that's something else they can do. They can also increase the bank reserve ratio. Banks don't have to keep all the money that we put in them. So all the money that you have in your savings or checking account, that money is not all there. The banks keep enough money in their vault to cover daily activity or if a certain percentage of people close their accounts. But they don't keep enough money in there for everybody to pull out all of their cash because they loan it out. That's how banks make money. They take the money that you put into your checking account. So let's say you have $200 in your checking account. They've taken out $197 and loaned it out to somebody else and are making interest off of it. That's how they make a profit to pay their employees and their stockholders and all those kinds of things. So what the bank can do, or the Federal Reserve can do, is change the reserve ratio. If they raise the reserve ratio, let's say it was 3% and they raise it to 10%, that means banks have to keep more money in their vaults and they can loan out less. And so that has basically the same impact as raising interest rates. It means that loans are less attractive or less capable of being given out, and so less activity is going to happen in the economy. There's also another one that governments sometimes engage in, but it's awfully faulty, and that would be direct wage controls. It's when rules are basically made to stagnate or stop wages from going up. And an economy as massive and complex as the United States, of course, this is highly unlikely. And when it's been done in the past, it's mostly been voluntary. For instance, during World War II, FDR and the Roosevelt administration made deals basically with unions. Hey, don't go on strike and ask for more money during this time, and we'll give you full support and make sure that your legal rights are protected and so on. And we need to do this out of patriotism, so that way we don't have runaway inflation during World War II. And so unions mostly agreed to that. And by the way, that's also why we have health insurance, because when they did negotiate with companies, the companies said, what can we do to keep your labor? And the unions would reply, well, you got to give us something. We're not asking for higher wages now. And so that's when companies started offering health insurance. So anyway, these are the things to deal with inflation. And the last one I want to mention would be anti-poverty programs. The anti-poverty programs in the United States often focus on the word welfare, and I'll get to that in a minute. But actually, there's quite a few other things that can be done to fight poverty. Enterprise zones can be established, which are areas of underdevelopment where there's lots of poverty that businesses are lured to by giving tax breaks. So maybe in a zone you offer to exempt them from their taxes in that area, and that allows more businesses to show up. There are criticisms of that, though, because some very wealthy companies can take advantage of that, and they go to that location just to avoid taxes. And people say, well, wait, these taxes actually help fund the roads and the local water and sewage and other things, so this company's going to be here. It's not going to help pay for any of this. So there can be some criticisms of that. Government employment assistance, training, unemployment insurance, minimum wage, those also help stop poverty. There are some criticisms. We already mentioned the ones involving unemployment insurance, for instance, and minimum wages. Small businesses can't afford increases in the minimum wage. And it also, when the minimum wage is higher, it causes more people to seek those jobs, and those with a bit more age or experience are going to get those jobs, cutting out newer, younger employees from entering the workplace. So there is a problem. There are criticisms with minimum wage. However, on the other hand, throughout most of human history, we didn't have a minimum wage, and companies took great advantage of employees and will pay their employees almost nothing if they're able to get away with it. Then, of course, there's actual welfare, which involves quite a few different programs. Food stamps, which is meant specifically to buy food. It used to be, of course, actual coupons, but now it's with a card, like in states like Pennsylvania. And it is limited to non-prepared food. So someone can't go to the deli in a grocery store and get chicken that's been made for them or stuff like that. So it has to be food off the shelves. Some people say, shouldn't it be healthier food? But healthier food is more expensive, so that will use it more of the food stamps money or require taxpayers to pay for more of it. And of course, paying for healthier food also required some kind of auditing system. How are you going to check to make sure people are buying healthier foods? And so you're going to have checklists, and cashiers are going to have to check it off, and the grocery store is going to have to keep records, and the government bureaucracy is going to have to check to make sure the cashier or the grocery store isn't working with the people using food stamps to take advantage of the system. And so that often requires a more expensive bureaucracy, offices, paperwork, and so on in order to do that. And so expecting more values out of any welfare program often requires greater expense to the taxpayers. the cheapest welfare programs are those that just give out cash with no requirements. But of course, those are controversial because then people say, well, where's my tax dollar? Where are my tax dollars going? Then there's WIC, or Women, Infant, and Children. That's an example of a program that does have restrictions. And if any of you have ever seen in a grocery store, for instance, someone using WIC, they often have a paper list, and it has to be checked off what items are being purchased, and it's limited to very specific things, and that list has to go somewhere, and it has to be checked by someone. So that is an example of a program that does have very specific requirements. Then there's assistance for heating and electric through utility companies. Sometimes utility companies for the private sector do this themselves, but other times governments can assist. And then there's housing, public housing. Either vouchers can be given, which is a payment to landlords for people that are below the poverty line or just barely above it, depending upon the number of people in their household and their income levels. It determines how much they get for that voucher. Or the government actually owns public housing facilities, either for families or for the disabled and elderly. And these are operated by county sometimes or state governments, and sometimes it can be an odd arrangement. In Pennsylvania, for instance, the Department of Agriculture helps out with public housing in rural areas. At the federal level, it's mostly under the Department of Housing and Urban Development. So it depends upon the state and level of government about who exactly runs the program. And then there's Temporary Assistance for Needy Families, or TANF. And this is a grant that has a maximum benefit to states, a block grant, and it is handed out to each of the 50 states, and the states have to do with it what they want, so it does give them some freedom, but there are some specific restrictions. People can stay on the Temporary Assistance for Needy Families, the cash payments for it, and this is commonly the one that we know of as welfare, and they can stay on it for 2 consecutive years, or a total of 5 years throughout their lifetime. So when people say, oh, I know someone that's been on welfare for a long time, well, not really. I mean, that's not allowed. They might be confusing it with someone that's on disability payments or something like that, but TANF is limited to 2 consecutive years or 5 years total. It requires that all recipients of welfare, the adult that is, able-bodied adults, find work in 2 years, and that single parents manage to get at least 30 hours per week of work, and then 2-parent household gets between 35 and 55 hours a week per household. And that's, of course, because one parent might be taking care of the kids and so on. And there's a lot of stereotypes, but actually people on welfare are less likely to use drugs because there's, quite frankly, not enough money to do that. They are less likely to have children. They are likely to have jobs because the program requires it. In fact, some people work 2 or 3 jobs. And so a lot of the stereotypes about temporary assistance for needy families or welfare are actually false. And this is another example of the more restrictions you put on, the more expensive the program becomes. For instance, if you instituted drug testing, and some states have piloted this program, you find out, of course, that a very low percentage of people actually use drugs. And when you kick them off, the savings that you get is actually lower than what it costs to run the drug program in the first place. So that's one of the issues. A lot of people don't like what can be done with welfare by drugs, by alcohol, for instance, or people go to businesses of a perverse nature or gambling or whatever. But the problem is the more you try to police that, the more expensive the program becomes. And so this change to the cash payments was commonly known in the 90s as welfare to work, instituted by President Clinton, a Democrat, and a Republican Congress. And so that's helped change it by giving the states more freedom and by instituting these work requirements. And overall, welfare programs since the 1960s have helped decrease poverty levels from the mid to upper 20s to the mid to lower teens. But the question is, how do we get it to go lower than that? Social Security has helped keep the elderly out of poverty. In fact, the age group that is most likely to be impoverished now are children. So what do we do about that? That involves giving the parents money, but people don't like that. Well, that's not right. We shouldn't give the parents money for having these kids. That was their choice. But then that still, of course, sticks the children in poverty. It really wasn't their choice to be in this situation, but here they are. And so the question, what do we do about that? When it comes to missing children, that often happens because of abuse or standard of living, and so kids often run away or they're taken by others, and So a lot of problems involving domestic situations and some crimes involving children often are because of this issue that seems to be plaguing those under the age of 18 in particular, including a wide variety of other things, malnutrition, health issues, and so on. So we tackled to a great amount of success poverty amongst the elderly. There are still issues there, obviously, but because of Social Security, elderly men and women are on par with working age men and women. And so the question is, how do we approach poverty for children in particular, and how do we keep reforming welfare to make sure that we're getting people back on the job and on their own 2 feet?